This is Kitco News. I'm Jeremy Szafron. Well, stocks are rallying, but the pressure hasn't gone away. Wall Street kicked off the week with the S&P 500 jumping over 1%, but reversing a 4-day slide as investors reacted to the news that the U.S. and EU may be backing away from a major tariff clash. Now, President Trump has extended the deadline of his 50% tariff threat to July 9th, and both sides say negotiations are now being fast-tracked. But the bond market is signaling deeper concerns. The yield on the 30-year Treasury has dropped back below that 5% mark after hitting a 19th-month high last week, and the 10-year is trading around 4.47%. And traders aren't just reacting to tariffs, they're reacting to the scale of fiscal risk now priced into Washington. And they're looking closely at Japan as well, where rising yields are raising global alarm. And we're also keeping an eye on the dollar. It's weakening, and gold is holding near $3,300 an ounce, silver pushing towards $33. And these are not disconnected moves. They're part of a broader story, one tied to trust, credibility, and a growing reassessment of monetary value. Now, that's a backdrop for one of the most widely followed reports in macro finance. Now in its 19th year, the In Gold We Trust report reaches central banks, fund managers, and individual investors worldwide. And this year, its message is unambiguous. We're entering a new monetary era. Now, the report lays out a case for a long-term rotation out of fiat trust and into hard money, and it challenges the official narrative on inflation. It also argues that gold and increasingly silver as well are regaining their role, not just as hedges, but as a strategic reserve. Joining me now is the man behind the report, our friend Ronnie Stoeferle. Did I say it right, my friend? Managing partner at Incrementum AG. You're a fund manager. You're also the co-author of what we just talked about, the In Gold We Trust. 19 years. Good to see you back here, Ronnie.
Thanks for having me, Jeremy, and thanks for not butchering my last name. You did a great job.
I try. Every interview, I get a little bit closer, Roddy. Okay, let's start with this report that you're talking about, because obviously everyone kind of pays attention to this report. We watch it come out year after year, and it makes a provocative case. I mean, the most important asset today isn't gold or tech stocks. It's trust, and that trust is evaporating. You write, quote, trust is now the scarcest asset in global markets. So let's talk about this. I mean, what's driving this collapse in confidence? Is it debt levels, inflation credibility, or is it geopolitical instability?
Well, Jeremy, I think we've seen already over the last couple of years that people have lost trust in politics, in the media, in our monetary system, in science. And I think that within only a couple of weeks, Donald Trump has created an even worse bear market in credibility and trust. So it seems that now also mainstream kind of realizes that something is cooking. So we chose the title The Big Long, obviously, as it kind of echoes The Big Short. And I rewatched that brilliant movie a couple of times to prepare for this year's report. And I think there's quite a lot of similarities, because back then, Michael Burry, Steve Eisman, they were kind of, contrarian investors. They weren't respected at all. They weren't taken serious on Wall Street. But then at some point, say like mid 2006, early 2007, I think that even more and more people on Wall Street realized, okay, something is really cooking in subprime markets. Something isn't right if you basically package all those subprime bonds and then put a AAA rating on it. And I think we're now at this kind of tipping point where more and more people are realizing that some sort of a realignment of our monetary system will take place. I think it's something that the Trump administration is quite vocal about. I mean, Scott Bessent said, I could see in the next few years that we are going to have some kind of a grand global economic reordering, something on the equivalent of a new Bretton Woods. There's a very good chance that we are going to have that over the next 4 years, and I'd like to be part of it. So I think all those topics like a reorganization of our monetary system, a revaluation of US gold reserves, all those topics now are really becoming mainstream, while, a couple of months ago, they've mainly been discussed with our tiny little gold bubble.
Yeah, you're not kidding. I mean, a lot of eyeballs on the story, and of course, a lot of eyeballs on the Fed, too. I mean, we're going to get more into that report, but looking ahead to the next major data point, I mean, the Fed's preferred inflation measure, the PCE index, is out on Friday. Markets expect a slight uptick, but can the Fed realistically stabilize inflation without tipping the economy into a recession here?
Well, it's pretty obvious that that inflation is much more sticky than expected, and my take has always been that inflation is also to a very large degree a psychological phenomenon. So if business owners, if consumers, if investors think that inflation will remain a concern going forward, you can have the best econometric models. It's not gonna work. So I think at the moment with, all this tariff uncertainty, with stagflationary concerns, with core inflation being elevated basically all over the globe, above the 2% barrier, while on the other hand, central banks being quite desperate, to lower rates again. I think that's kind of the perfect storm for gold going forward. And from my point of view, even though that's still, if you have a look at inflation pricing, if you have a look at break evens, if you have a look at inflation expectations, nobody really discounts a second inflation wave at the moment. But I would definitely not rule that out. And I think that if we study history, if we study monetary history, for example, in the 1970s, which was also obviously a big bull market in gold, we've seen actually two inflationary waves, and I cannot rule out that history is going to rhyme.
Yeah. Okay. Let's talk about gold. I mean, you just brought it up, and obviously in the report, you say that we're still mid-cycle in a decade-long secular bull market. For context here, I mean, gold has already hit 43 all-time highs last year, 22 more this year alone. I mean, I talk about it all the time, and today it's trading just under that $3,300 an ounce mark. What's driving that momentum right now, and how much further could this run go?
Well, I think, gold is not a contrarian investment anymore. Is it a crowded trade yet? I don't think so. I think this bull market is still mainly driven by emerging markets. This was basically the narrative and the leitmotif of last year's In Gold We Trust report, the new gold playbook, where we explained that the center of the gold world has moved from the Western world to emerging markets, to the Arabic world, to China, to India, and they are responsible for the majority of the gold demand now. And we also explained that central bank demand, buying more than 1,000 tons 3 years in a row, that's also a very important driver for the price going forward. However, Western financial investors haven't really caught up yet. I think they completely missed the gold party last year. Inflows into gold ETFs only started in the second half of last year. And still those numbers are, I would say, still on the very low end. While in the US, we're seeing some inflows into gold ETFs. On the other hand, in Europe, for example, we've seen outflows. So I think that the market in the Western world is still climbing this wall of worry in the gold world. I think, most of the people that I talk to, they ask me, should I sell gold now? But nobody is really super excited to buy gold at these price levels, because everybody thinks, okay, buying something at a new all-time high or close to an all-time high, that's already too late. But if you follow, I don't know, every bull market, if you missed like Nvidia, how many all-time highs did it make? So from my point of view, we are based on the so-called Dow theory. We're not in the so-called accumulation phase anymore. We're now in the public participation phase, which basically means that in this second phase, which is kind of the big move phase, according to the Dow theory, we're seeing that the media picks up on the topic. We're seeing that speculative interest is rising. We're seeing rising trading volume. We're seeing that financial products are launched, and that analysts actually adjust their price targets upwards. And this is exactly what we're seeing now. last year, 1 year ago, the analyst consensus from all the Wall Street banks was basically that the price of gold will drop below $2,000 again, and that we'll see a major bear market until 2028. Now they have all raised their forecast, but they're expecting basically a sideways trend over the next couple of years. Nobody is like super bullish yet. I think that's going to happen. And therefore, I would say that we're somewhere like at the beginning of the second half. If we talk soccer terms, if we're talking, I don't know, baseball terms, it's probably the fifth or sixth inning, something like that. But I think this mania phase, this final phase, this distribution phase, is still ahead of us. And our view is that within that phase, actually, it's going to be what we call performance gold, which will be outperforming gold itself. What is performance gold? That's silver, that's mining stocks, also commodities, and to some degree, Bitcoin. So our take is gold is in an established bull market. It has way to go, but now will be the time to start overweighting what we call performance gold.
All right, so Ronnie, you're calling it this big move phase, this next phase in the bull market. What is the price action telling us? Not just about inflation, but about global trust in monetary leadership. I mean, is inflows to come? Will the Western investors start to look?
I think that's going to be the main topic going forward, that Western financial investors will finally realize that some gold allocation makes sense. So I think, I'm clearly not in the, gloom and doom camp, let's put it that way. I think there's a very sober and positive case for gold to be made. And I think that gold made a tremendous job just working really well, doing its job as a portfolio diversifier, but not only as a defensive asset, but also working really well as a kind of offensive asset in the portfolio structure. So a little bit like, Dennis Rodman responsible for the rebounds, but also Michael Jordan scoring points. So I think that, we put out a special publication last year where we said between 14 to 19% is the optimal gold allocation in the context of a typical balanced portfolio. Now, we quote, for example, a study by UBS where they showed the portfolio structure of family offices. And it says that family offices now hold 1% allocation in gold and precious metals. So institutional allocation still remains strikingly low. And I think that's going to change at some point. And just, one example from my daily business, we just got an inflow in our gold Bitcoin fund from a small Swiss pension fund. And I think this is quite telling because those institutional investors, they tend to be somewhat bureaucratic, let's put it that way. And the larger they are, the longer it takes for them to make decisions. And I think now, within the context of this public participation phase, it's also, if you're sitting like in an investment committee, it's much easier making a positive case for gold as a portfolio diversifier compared to 2020, for example, where we came out with our outrageous forecast of $4,800. So I think this will be one of the main drivers, the Western financial investors now finally waking up that they need a little bit more gold allocation in their portfolios.
Yeah, good point. Obviously, still some room to run. You mentioned that $4,800 that you talked about. Some people thought you were crazy. I mean, yet here we are. I talked about all these new all-time highs. And this time around, you outline a long-term target between that $4,800 and $8,900 by 2030. And it's a wide but ambitious range. Walk us through the scenarios behind those numbers and what gets us there.
Well, we introduced this Incrementum gold price model in our 2020 report, where we forecasted that it's going to be a golden decade. Now, since then, gold is up, I think, 92%, beating bonds and obviously the classic 60-40 portfolio. And, back then people said, what are those guys drinking or smoking or doing? But we actually said, okay, let's come up with a very simple monetary model for gold, because we regard gold as a monetary asset, obviously. And the most important driver for that is M2 growth, but also what we call let's say the trust level in our monetary system. So those are basically the two drivers of this model. And based on the base case of our projection, we'll see 4,800 by the end of this decade, which also means that we're slightly above that interim price target, which would be 2,900 by the end of this year, 2025. However, we also have a more optimistic model, which says, okay, in an inflationary environment where M2 grows more aggressively, we're seeing what Larry Lepard called the big print. Then we would come up at $8,900 by the end of this decade. Now, this also sounds pretty outrageous. However, if we compare gold, for example, to the market cap of gold to the market cap of US equity markets, we're only slightly above the very long-term averages. We're far away from those levels that we've seen in 2011, and even further away from those levels in the 1930s, 1940s, and at the beginning of the 1980s. If we have a look at, kind of a monetary valuation of gold, I would say that gold it's not super cheap anymore, but I would say it's kind of reasonably priced. So for example, gold, the percentage of gold as a backing of the monetary base, on average, we've seen 45%. We've seen 130% in 1980. Now we are around 16%. So I think there's still lots of leeway for gold to go if this monetary renaissance that we're kind of forecasting, if this is really going to play out. And as I've said before, Scott Bessent is talking about it. Stephen Mirren published a tremendous paper last year where we basically outlines the playbook for this reorganization of our monetary system. So I think some sort of a reverse 1971 will happen sooner or later. And I'm just really convinced that gold will play a major role in that reorganization.
Yeah, interesting. I mean, you talk about that trust in the monetary system, and you also note that there's been a sharp rise in central bank gold buying. We know that. I mean, it's up 70% since 2018. Some analysts say that this is just diversification, not really a structural shift. But you're talking about Bessent there. I mean, what evidence do you see that this is about more than just balance sheets, and it is that monetary strategy going forward?
Well, if you listen to Bessent, and I mean, Scott Bessent is a very interesting person. He seems to be the key guy in the Trump administration. He's got a very interesting background. He worked for Soros. He traded alongside Stan Druckenmiller, probably the greatest investor of the last couple of decades. He says that they called him a gold bug. He says that his biggest private holding is actually physical gold. So I would say this man truly understands gold, and it's not only Bessent, it's also Howard Lutnick, it's Stephen Mirren, it's Elon Musk talking about auditing Fort Knox, for example. So gold has really become, if you compare it to a I don't know, a music festival, it used to be like, the band where like only 10 drunk people stay because they don't really know what's going on. But now gold is coming, it's becoming the main act on the main stage. And I think that's really the major difference compared to, let's say, like 2 or 3 years ago. Now, if we talk about this reallocation of our monetary system or reorganization of our monetary system, obviously we have to talk about the Triffin dilemma. We have to talk about the role of the US dollar as the monetary reserve currency, as the leading currency of this world. And it seems that the US wants actually to have like. It wants to achieve a significantly weaker US dollar, but then on the other hand, they also want to have some sort of a controlled dollar devaluation and still remaining the world leading currency. This is, as we call, asking for warm ice lollies, or, squaring the economic circle. Something's gotta give. And therefore we describe, in the report, all those suggestions by Stephen Miran, what Michael McNair recently wrote, also what Judy Shelton with her proposal regarding gold-backed bonds actually came up with. I think that's a very, very interesting proposal. So as I've said, if you study monetary history, you will always see that, those monetary realignments, reorganizations, however you want to call it, they happen every couple of decades. And in this transition period, gold always played a major role. Now we know that gold is still by far the largest reserve of Western central banks. We know that emerging markets are hoarding gold like squirrels preparing for winter. And we know that there's also this enormous trend of gold repatriation happening. And we've seen the US recently importing more than 2,000 tons of gold. So I think if you connect the dots, it's pretty obvious that something big is going on behind the scene.
Okay, so Ronnie, you also compare today's moment to a new Nixon shock. So let's lay out what you call the Mar-a-Lago Accord, and more specifically, what it means for gold.
Well, Jeremy, nobody really knows what's going to happen. But I think, what we call, this dollar milkshake theory by my friend Brent Johnson is kind of meeting a Mar-a-Lago Accord where, the US administration wants to have some sort of a controlled devaluation of the US dollar to achieve, obviously, this renaissance of US manufacturing. So I think there is some opposing ideas behind those developments. So from my point of view, it is, first of all, if we compare it, for example, to the Plaza Accord and the Louvre Accord, the context was somewhat similar. We've seen enormous strength in the US dollar before, and then they said, well, actually, this is gonna kill the world economy. We have to do something. So they met in New York and came up with that Plaza Accord with the controlled devaluation of the US dollar. It worked, but then actually they had to stabilize with the Louvre Accord again. However, those structural imbalances, of the G5 nations back in the days, I think there are some similarities, but I would not expect, especially with kind of the negotiation strategy that Donald Trump has delivered over the last couple of weeks, that we will see some sort of a very diplomatic agreement. I think it's Trump really wants to use this sticks and carrots policy, a very, very aggressive policy that also Stephen Miran described in his paper. And I think the major difference compared to back then is that those imbalances are actually very, very skewed when it comes to trade, to the dependence of the United States versus China. So I think this is really the elephant in the room. I think the deficits versus Japan versus Europe are, if we compare the numbers to China, the Chinese numbers, I think that's pretty insignificant. Now, what's gonna happen and when is it gonna happen? I don't know, but I think with Donald Trump's basically first big trip abroad, he went to Saudi Arabia. Perhaps it's no coincidence that in his first term, his first trip also went to Saudi Arabia straight. I would expect some sort of a deal with Japan over the next couple of weeks. So it seems that the end game is really US versus China. And I think that China has much more leverage compared to Donald Trump's first term, because back then, Chinese exports to the US were like, I think 17 or 18%. Now it's only 13%. So the Chinese in the meantime have done a great job kind of diversifying their economy, exporting, more high value products into other emerging markets, and therefore I think they're not that dependent on the United States anymore. But again, I mean, that's the fascination of my job, of our jobs in this world, to follow what's going on. But I am pretty certain that something big, some sort of a big agreement will happen over the next couple of weeks, and I also think that gold will play a major role in that, because everything that I read from those high profile people in the Trump administration really points into that direction.
All right, let's turn over to fiscal policy, because as we talked about from the beginning there, President Trump's new tax and spend package is projected to add nearly $4 trillion to the deficit, combined with war spending, of course. We got aging demographics and then this rising interest costs. Ronnie, are we now in a phase of permanent fiscal expansion?
Well, I think that's what's really interesting about Donald Trump is that he really addressed three major problems. First of all, the chronic trade deficits and the deindustrialization of the U.S. So basically, the Triffin dilemma and the importance or the consequences of the strength of the U.S. dollar. Then also the threat to the reserve currency status of the U.S. dollar posed by this de-dollarization that we're talking about for ages now. But he also talks about the steadily increasing over-indebtedness of the United States. And I thought it was interesting that this self-proclaimed king of debt has kind of abdicated with, big announcement regarding Doge savings and, 333. So basically only a deficit of 3% anymore. While actually, so far we haven't seen any major success. It seems that the realized savings for Doge will be 155 billion, while federal government spending in this fiscal year is 6.7 trillion. And during the presidential campaign, Trump said that they will actually save 2 trillion. So 2 trillion versus 155 billion. Not extremely successful so far. And Trump was very vocal about this, what he called a detox recession, which reminds me a little bit of my beloved Austrian school, where they say, okay, the Austrian school emphasizes that real value is created in the private sector, and that we have to shrink the bureaucracy and the state intervention to free up resources for entrepreneurship, for a little bit like a fasting process, where the organism is becoming more resilient and more efficient in the long term. Now I try to fast every year for like a week, and I can tell you it's not pleasant. You're seeing pain, dizziness. You're getting kind of psychological irritation in the first 3 days. So it's tough. And it seems that this detox period that Trump and Besant were referring to, I think it was a little bit of a joke, because actually the bond market responded very quickly to all those things. And just have a look at the last treasury auction. Just have a look at what's going on in bond markets, also in Japan and in Europe. So I think, the market is so addicted to more and more debt, to fiscal stimulus, that I don't really see this detox recession being accepted from the Trump administration, but also not from basically governments all over the globe. So I think it's a little bit, I think we're kind of trapped in that environment. I think that's a consequence basically of the COVID years, where fiscal stimulus really became mainstream. And I think that politicians saw, okay, well, do some fiscal stimulus, and it has an effect on the economy. It has an effect on consumer sentiment, on spending behavior, also on inflation, because inflation numbers were way too low back then. And I think we're kind of getting addicted to that. So therefore, I don't really see that Donald Trump will continue with all those big announcements regarding Doge. I think it's actually it sounded great, but I think in reality it's just not that easy, and I think Trump is kind of realizing that now.
Yeah. So what you're saying, and I mean your report argues this too, is that deficits are no longer cyclical; they've become more structural. I mean, I'm curious what implications are going to become from that shift. I mean, U.S. interest expenses now top defense. I mean, how does debt sustainability feed into your $4,800 to $8,900 decade target?
Well, obviously, I mean, the U.S. spent like $1 trillion just on interest payments last year, which is pretty significant. And I think that's a so-called Ferguson's law, where Neil Ferguson said that every big empire that basically spent more on their debt servicing and on their interest than on defense basically went under, and he's coming up with a couple of examples, like a Habsburg Spain, but also the Ottoman Empire. So it is definitely pretty, let's say, interesting development that we're seeing now. Obviously, the bond market is the big elephant in the room, and I think that if we have a look at the price action of gold versus cash versus bonds, and now also versus equities, I think that's very telling. So we've got a couple of ratios in this year's report where we say that gold, the relative strength of gold versus cash and versus the bond market is in a secular bull market. But what we haven't seen so far is real relative strength versus equities. And I think this will be a major part of this next stage of the bull market. Why, so I think that, if we have a look at valuations in equity markets, despite the recent price declines, we write in the report that the US stocks remain as far away from favorable valuations as the Bahamas are from the introduction of mandatory snow chains. So I don't really see too much value in US equities at the moment. We're seeing lots of opportunities in European stocks still, also in emerging market stocks. Brazilian Bovespa, for example, is trading at a Schiller PE of, I think, 9.5 at the moment. And if there's really big rotation happening out of the US bond market and out of US equity markets into other markets, like, for example, European equities, emerging markets, but also into gold and commodities, that would be a big driver. Now, Jeremy, I think what was really interesting was, beginning of April, it seems like ages ago already, Liberation Day, obviously, there was major turmoil in markets, big volatility. And what you would normally see is, in such an environment of kind of chaos and panic, you would normally see the US dollar strengthening, and also US Treasury being sought after and being bid. We've seen that initially, but then it actually completely reversed, which is kind of the sign for this paradigm shift that we're seeing from my point of view, where this traditional safe haven isn't regarded as a safe haven anymore. Perhaps it's a safe haven with pirates waiting everywhere. So therefore, I think if that rotation out of bonds, out of US markets in general, if that's gonna continue, I think it's definitely gonna be a major source of capital for gold.
Interesting. Okay, well then, Ronnie, we got to talk about your asset allocation model. I mean, you got this new 60-40. It allocates kind of 15% to that safe haven gold. You got to break open this performance gold conversation. And I know you even have some Bitcoin in there. What's the rationale behind this mix, and how has it performed so far?
Well, it has performed. We introduced it last year, actually, Jeremy, because we're primarily asset managers. We run investment funds investing in value strategies, but obviously also precious metals, mining stocks, commodities. We've got 2 funds that combine Bitcoin and gold, which is still very, very controversial. And, last year's report, the new gold playbook, we said that, this traditional 60-40 portfolio doesn't work anymore because, this allocation between equities and bonds was based on this negative correlation between equities and bonds. So every time, we've seen some turmoil in equity markets, bonds basically covered the losses, worked as a portfolio insurance. Now, the reason for that was primarily the fact that we haven't seen any inflation during that so-called great moderation phase, where actually inflation numbers were coming down. Inflation was the least concern for any portfolio manager. Now, with this, this renaissance of inflation, I think this traditional 60-40 portfolio doesn't work anymore because we're seeing a positive correlation between equities and bonds now. And if inflation should remain a concern, which is kind of one of our main messages, then I think you'll need an alternative portfolio hedge, which gold should do pretty well. So we said we would recommend a significantly lower allocation on the bond side, only 15% in fixed income, and we would be still underweight government debt. We would favor more corporate debt, more emerging market debt. And then we say you should have like 15% what we call safe haven gold. So this is physical gold where you don't really care about daily fluctuations. This is really a long-term monetary insurance where you should consider where to store it, where you should consider, counterparty risks. Do you really want to store it with your bank within your country? I think you've got no idea how many really, really ultra high net worth individuals now ask us regarding geographical diversification of their gold holdings. They don't want to stare it only in Switzerland anymore. They're talking about Dubai, New Zealand, Australia, the US, London, whatever. So this has become a real topic. But within this safe haven gold, 15%, this is really something that you hold for the long term, that you ideally inherit to your kids or to your grandchildren. And then we've got what we call performance gold, which is silver and mining stocks. This has to be actively timed. Now, there's André Costolani. He was kind of a guru in Europe when it comes to investing in equities, or kind of a Warren Buffett's type of investor. If you buy mining stocks or silver and you take sleeping pills and you sleep for 10 years and you wake up, Costolani would say, well, with equities, you will probably wake up and you're rich. When it comes to silver, when it comes to mining stocks, I'm not 100% sure about that. So our take is that those two assets, which have some sort of a leverage on the gold price, which are highly correlated to gold, obviously, they should really be actively timed. So this is not a buy and hold investment. This is really a very active part of your portfolio allocation. And then we say, okay, 10% commodities should also be included, 5% Bitcoin, and the rest, which would be 45% equities. So Jeremy, just one last thing. I think many people in the gold industry think that stocks are actually the enemy of gold. I completely disagree. I think, the major source of capital and of flows into the gold market will come from the bond side. I think there's a strong case for equities to be made. Not sure if you should still be super overweight US equities, but I think bonds, this is really where the gold market will take at least tiny parts of the allocation. And we all know that the bond market is by far the largest investment class on this planet.
Yeah, Ronnie, I'm going to get you to talk a little bit more about that silver and some of those mining investments in a minute. But just as you were answering there, you were talking a little bit about where gold is going, but literally, I mean, your report highlights a clear eastward migration of physical gold. Countries like China, India, Turkey, others are steadily accumulating. And I don't see a lot of countries waiting to buy U.S. debt either. So let's talk a little bit about this signal of trust on the Western monetary system. But could we see a bifurcated gold market emerge, where Eastern and Western nations diverge on pricing, on settlement, and even on reserve practices?
Well, we've seen that to some degree, Jeremy. I mean, if you have a look at the premiums, Shanghai versus London, for example, there was, at some point more than $100 per ounce, which is pretty significant from my point of view. If you have a look at, the spreads between LBMA and COMEX, we've also seen that, I think, up to $70 per ounce, which is quite significant in a highly liquid and highly efficient market like the gold market, where there's like hundreds of billion being traded every day. That's huge, and it's telling me that it's actually, people have also kind of lost trust in paper gold. I think, as I've said before, this trend of repatriation of gold is another sign of this loss of trust in the international collaboration and the international, let's say, organizations and international trust. But then also the US importing more than 2,000 tons of physical gold. Who's buying that? Is it high net worth individuals? Is it institutional players? Is it perhaps even the US government? I mean, legally, it would be possible for the US to buy physical gold. So I think, there's clearly some change happening in the physical gold market. Now, how does it relate to this loss of trust in global bond markets? I think we shouldn't overestimate it, because if I talk to my former colleagues from the bank, they still couldn't care less about gold, I have to say. If I talk to asset allocators, as I've said previously, some are kind of considering an allocation to gold. But then due also to financial repression for most of them, it's actually not possible to buy physical gold for investment funds. Therefore, I think that the ETF flows are a very good proxy for the flows coming from institutional players from the Western world. And, only recently we've seen some inflows into gold ETFs. So this is kind of suggesting me that most investors, most investment professionals have completely missed the gold party. And the party is it's kind of gain of momentum. It's not super crazy like 3 a.m. Yet, where everybody passes out and the police is coming. But I think many people are standing outside and they think, okay, is it already too late? Should I go to the party? The admission fee is obviously a bit higher now. But this is kind of the picture that I have in mind, thinking about Western gold investors having not participated in gold yet.
Yeah, a little late to the party. Those are the Austrian parties, Ronnie. Okay, I got to get back to the report, because you write, quote, the global monetary system has split into competing blocks, US, EU, and BRICS Plus, with middle powers pivoting. Let's talk about BRICS Plus. With the latest developments, what's catching your attention? How realistic is a multipolar reserve system or even a gold-backed trade currency from BRICS?
Well, BRICS are, with the BRICS 11 now, and I think it's interesting again, having been to Saudi Arabia in January at the Future of Minerals conference, which was very, very interesting. And I think I did an interview with your colleague Paul at the conference. I think it was super interesting to see and to feel how important gold is actually for Saudi investors. And Saudi Arabia is invited to join the BRICS, but so far they haven't accepted the invitation yet, which is, from my point of view, very, very interesting. And therefore, it's probably not a coincidence that Donald Trump first went to Saudi Arabia. Now, still, I would say that the significance of BRICS or BRICS Plus is something that is really, it's a very long-term trend. And we know that the majority of the growth is in the BRICS countries. We know that their demographics, except for China, obviously, is much more favorable. We know that there's a very, very high gold affinity. So most of those countries in the BRICS are structural gold buyers, not only for private demand, but also their central banks are, as I've said before, hoarding physical gold like squirrels preparing for winter. And it's also I think it's also about, being taken serious. It's a little bit like this, the small brother that is growing up and the big brother doesn't really accept the fact that the small brother is actually competing now and that he's getting stronger and stronger. And I think that's what we're seeing. And I think that gold is kind of a sign also for emerging markets telling the Western world, okay, we want to be taken serious. We are important. We have kept up, or we have actually done a tremendous job. If you follow the interview that we have with Luke Roman and Louis Vicent Garf in this year's report, where we talk about technology coming out of China. I mean, it's really, really impressive what has been achieved over the last couple of years. Now, if we follow, the developments at the most recent BRICS summits, if we look at what should be expected from the upcoming BRICS summit in Brazil, I think that we shouldn't overestimate the role of gold, but it's pretty clear that this de-dollarization push is continuing. So it seems that that the BRICS are slowly working on alternatives to the current setup, alternatives to the SWIFT system, alternatives, when it comes to settling their trade in US dollar terms. So basically, more bilateral trade being settled in local currencies. This is all happening. And I think that Trump was, I think Scott Bessent once said that there will be basically 3 different buckets. So this will be the green bucket, the yellow bucket, and then there's the red bucket. And which BRICS countries are basically in the green bucket? I would say it's India, it's Egypt, it's the United Arab Emirates, obviously. Saudi Arabia, as I've said, would be in the green bucket, but hasn't accepted the invitation yet. Indonesia, not 100% sure. I would say in the yellow, in the kind of mixed bucket, would be Brazil, South Africa, and Ethiopia at the moment. And in the red bucket, so pretty negative perception, that would be China, Russia, and Iran, obviously. So we should not make the mistake to believe that, BRICS is like, just one block. It's actually, there's lots of competition within the BRICS. But I think it seems that, the more pressure the United States puts on other countries, I think the closer they start sticking together. And therefore, I think it's BRICS isn't merely an economic bloc. I think it's more of a geopolitical statement. It's kind of a declaration of intent to redefine the global power structures. I think that's really the importance of this development. And I think that gold plays a role when it comes to this kind of reorganization of our monetary architecture. But I think, we should not make the mistake and think that BRICS is all about, introducing a gold-backed currency. That's actually, if you read the material being put out, that's I think a little bit too much that we put into that.
Yeah, well said. Really good for you to kind of sum that up a little bit. Okay, Ronnie, I got a couple of questions before you head out here because I know it's evening for you. Let's talk a little bit about what's ahead. I mean, in your report, you warn that the greatest risk over the next 12 to 18 months isn't just inflation or recession. It's this systematic failure of trust like we talked about during this interview. What's the most likely trigger? I mean, is it a failed treasury auction, a sovereign credit event, or something else?
It could be a combination of that, actually. And I think that gold is kind of already pricing that in. I mean, have a look at what's going on in the Japanese bond market. By the way, we just published a report for the very first time also in Japanese. And if you have a look at gold in Japanese yen terms, I mean, that's one of the most beautiful charts out there. It could obviously be, the debt ceiling discussion coming up again. It could be an inflation shock, but it could also be actually, the fact that we will see that Donald Trump has to kind of, backpedal, that he has to reverse his policies. And we've already seen that. And I think that with the latest kind of threats against the European Union, I mean, I criticize European politicians quite a lot for good reason, but I think, what they did recently was saying, okay, let's take it easy. Let's discuss, let's negotiate. I think that's kind of the right approach to this, bullying that, everybody who has read, Trump's book, The Art of the Deal. Now, I think it's pretty easy to anticipate. Now, I think coming back to gold, I would say that we are in a bull market. That's pretty obvious. I think we are in a bull market that the Western financial investor hasn't participated in yet. A friend of mine made the cheeky statement saying that more people believe Elvis is still alive that own gold in the US. I think that's pretty accurate. I think, if we have a look at, just the gold performance, gold was up 27% in US dollar terms last year. It was up, I think, 35% in euro terms. It was up in every fiat currency. So we could basically say, if we kind of reverse it, because from my point of view, it's not the price of gold rising, it's rather the purchasing power of fiat money that is falling. Just in 1 year, the purchasing power has actually fallen by a third. So it didn't fall, it actually plunged. And also, let's not forget, Jeremy, that at the beginning of the year, the price of gold was trading at 2,700. Now we're trading at 3,300, and people are still talking about this gold crash or gold consolidation, and everybody's nervous, and sentiment has become pretty negative. We've seen a reverse of the commitment of traders report. So I would say, this loss of confidence and switching to a more bearish sentiment is a very, very positive sign going forward.
All right.
Now,
And Ronnie, I have to ask you, because you end the report with this key question. It says, what comes next? So let me put that to you now. I mean, if we do reach a point where trust in the system breaks, whether through this credit shock, some currency volatility, or even this political rupture we're talking about, what does a functioning financial strategy look like on the other side? I mean, what should investors or our viewers be doing right now to prepare for that kind of reset?
Well, our final quote is do you have enough non-debt money? And, that's not a Ronnie Stoeferle quote. It's actually by Ray Dalio, the founder of Bridgewater. And I think that, as I've said at the beginning, more and more high-level people like Ray Dalio, but also Warren Buffett actually making a pretty bearish case for the US dollar. People like Stan Druckenmiller. More of those high-level people are actually kind of joining us in the gold camp, which is a sign that, as I've said at the very beginning, it feels like the Big Short in late 2006, early 2007. So I think all those developments that we in the gold camp discussed for ages, revaluation of gold, some sort of a monetary backing of fiat currencies being reintroduced, kind of more turmoil in the global bond markets. I think all those things are kind of happening now, and we shouldn't make the mistake to become too bearish too quickly, because I can tell you many people that I know that are really diehard gold bugs, and I have to tell you, I hate the term gold bug, because I would never call somebody convertible bond bug or US tech bug. But, people that really understand gold and that, are in gold for already quite a while, I know quite a lot of them that turned very, very bearish because they said, okay, this is too good to be true. And let's not make the mistake to miss this big long, because I think, the second part of this bull market is just beginning. And as I've said before, I think now will be really time to reconsider a higher allocation in silver, in mining stocks, because in those two, what we call performance gold assets, we're still seeing enormous amounts of bearishness. Basically, nobody is allocated yet, while the fundamentals are tremendous. Silver is having the fifth supply deficit in a row. We're seeing that the mining stocks are producing record amounts of free cash flow. I think Agnico has like a $2,000 margin for every ounce of gold that they produce. They've been paying down debt. So I would say for gold is, again, it's not a super contrarian investment anymore, but it's not a crowded trade. But what is still a contrarian position at the moment is definitely silver and also mining stocks. And I think that at some point generalist investors will come in because they will say, okay, well, gold is a good idea. Perhaps it's already somewhat pricey. Let's have a look at the smaller brother. Perhaps let's add a little bit more leverage on the gold trade, and then they will end up buying silver as well as mining stocks.
Yeah, well said. Okay, well, a lot of our viewers are going to be excited to hear that. The big long, I wrote it down. I'm going to use it. Ronnie Stoeferle is the managing partner at Incrementum AG. He's the fund manager and obviously the co-author of In Gold We Trust. You can get that report, and I do suggest you going and downloading the full piece at ingoldwetrust.com. Thanks for this, Ronnie. I appreciate staying up for us tonight.
Thank you very much, Jeremy. All the best, and talk soon, my friend. Bye-bye.
We sure will. Appreciate your time. And if this interview challenged your thinking, be sure to share it. The monetary system is changing. Gold isn't just an inflation hedge anymore. It's becoming more of a trust anchor. For more interviews like this, real conversations about money, power, and what's next, subscribe and follow along right here at Kitco News. I'm Jeremy Szafron. Thank you for watching.